All right, today's video is not from a question, but more just an educational video and maybe some different viewpoints I have when it comes to using stocks versus ETFs. Number one, I still use both. I think that both can be very important. So it's not saying one is better than the other. Second is that diversification. Everyone knows that it's good. An ETF can be a very valuable tool to diversify a smaller portfolio. But as you get bigger, then you can start adding stocks and still create a diversified portfolio. This is an important note. If you have an ETF, it can still have concentration risk. Concentration means a company risk. And there's a lot of your portfolio is in one company. Say you have an ETF that tracks the S&P 500, like SPY. The S&P 500 is 500 companies, but the top 10 make up 36%. And technically, two of those top 10, there's two different shares of Alphabet. So the top 10 are driving the returns. If you look at number 1 and 2, it might be Nvidia and Apple, and those two might make up 14%. So if those top 10 move one way or the other, your whole ETF is moving, even though you have 500 stock. So there's still some concentration risk when you have ETFs, and you got to be careful about that. If you had a larger portfolio, actually it's easier to diversify with stock than it is with ETFs, because then you don't have certain stocks running up and making up an automatic high position in your portfolio. Number 3, I think stocks can be easier to understand. A stock, you get to look at all the financials of the company. You get to hear what the management's saying about it. You get to see this is a tangible product or service that's being offered, and this company is making money. And how I'm making money as an owner of the company, they're able to do well as a company, and then I'm profiting from it. It just seems easier to understand. That's one reason, after talking and meeting with so many people that have company stock options, that they feel even though their company stock is made up a big portion of their overall investments, that's the one they feel most comfortable with, just because they understand the company. So I just think that's easier to understand. It gives you a sense of relief that you're not going to have such unpredictable ups and downs. You kind of know what's going to happen. As you move on to larger portfolios and you start looking at different ways to invest, options is something that I use quite a bit personally. And I'm going to give an example of how a stock on the options market can be more favorable than an ETF. And what I did was just say, let's look at if you have an overvalued market, and you don't necessarily want to hold a stock, but you want to hold a cash secured put. I'm going to try to run down the difference between a cash secured put on an ETF versus a cash secured put on a stock. And first off, just say that the stock and the ETF, for illustration's sake, are both about 15% overvalued. It's like, say I made all this return on it. I think that we're way overvalued. I'm going to sell some off, but I still want to have a cash secured put. So I'm making some money, but then I'll buy back in at the price that I want to. All right, let's look at SPY. So let's say SPY is at about $685. Then we have an intrinsic value of $582, which is about that 15%. And then let's now look at Amazon. We think that both SPY, which is the S&P 500, and Amazon is both overpriced by 15. So if you're overpriced by 15, you want to set your options contract at the intrinsic value is the strike price. So we looked at 215, that makes it about 182. Now you can't always get exactly 15%. I looked at a 75-day option contract. And then I did the contract at 585, so pretty close to 582, and 185. So a little bit different percentage-wise, but this is just mainly for illustration's sake. What was the overall percentage return in that 75-day contract? Well, in SPY, I was only getting 1.38%, whereas in Amazon, I was getting 3.11%. So that's an all-in return, counting the money market, that's the cash portion of the security, and then the premium that you're getting for that 75-day contract. Because if you set a cash secured put, is you're selling a put option, receiving premium, and then the stock gets put back on you at the price you set. So, just a quick little lesson on cash secured puts. If SPY or Amazon, if the price drops to 585 or 185, then you get to just simply essentially you're getting the stock back at the price that you think is most appropriate. But you're protecting yourself from the risk of 685 down to 585. But the point being is the ETFs, they don't have as valuable as market. Like I'm getting 3.11 versus 1.38. Now, and then if you do this across several stock, plus you can kind of pick and choose, where if you just do SPY, some of those stocks aren't overvalued, where you might have a portfolio of 35 stock and 15 are overvalued, and of those 15, now you have diversified set of option contracts that fit directly into your portfolio. But ultimately, stocks, you can look at all the options contracts, go onto the brokerage, try it out yourself. Oftentimes will give a higher premium than what a normal ETF will.